Another major milestone for your money, the Dow closing in on history. For more on how high it can climb from here, we welcome in Brian Belski. He is the founder and CEO and Chief Investment Officer at Humilis Investment Strategies. It is good to have you on what looks to be a record-setting day yet again, Brian Belski.
Yeah, Scott, it's really exciting. We like it when stocks go up. And, you know, I think for us, the most gratifying thing in your open was this kind of broadening out of what's happening. You have healthcare doing very well after the sector has dramatically underperformed, and financials today as well. So, I mean, we're not surprised to see some better performing areas come in, but obviously we're very, very happy with respect to the markets over the last couple of weeks.
Is this what an everything rally looks like?
We're hoping it's going to continue to develop into an everything rally. The broadening out isn't happening like we thought it would on a more consistent basis. We think that's going to be a trend that really unwinds and happens into 2026, Scott. But this is a very good sign, especially considering the move in healthcare, which we think is very, very promising. We're starting to get back to fundamentals. People are focusing on cash and cash flow within healthcare, and I think that bodes very, very well for fundamental investing.
So you think we're going to have more of a broadening in 26? Do we get away from this highly concentrated trade?
Well, you know, some would say there's been so many different studies on this, Scott, and we've done them too. That it's not so bad to have this very concentrated thing, and the markets have shown that the last couple of years. So we're not going to bite the hand that feeds us. But I think being a purist like ourselves, we want to see more stocks do better, more companies perform along those lines. And we're seeing that in the numbers with respect to where earnings are coming out. You talked about some great mid-cap stocks that have come out with great earnings. So we're starting to see that stock by stock. And, you know, my old adage, the stock market is a market of stocks. So we're starting to see it bubbling up from the stock level. And I think from the wherewithal of the longer-term secular bull market, which has been our thesis now since 2009, I think that just bodes better and better and better news from a fundamental perspective as you start to see these companies actually perform fundamentally, and especially on the earnings growth basis.
I mean, markets obviously don't go up forever. I hear you on the call from '09, a secular bull market. But where are we, do you think, in the cycle?
That's a great question, and we've said when we moved our target to 7,000 recently, we said stocks are rarely linear for long, and we said that there's probably going to be some sort of a pause in here, and we're probably going to be too low on our 7,000, quite frankly. But at the end of the day, I think on this cycle, this part of the bull cycle, which we were in print on talking about in November of 2022, we're 3 years in. So if you go back and look at history, Scott, and you know this very well, that the third year of the bull market usually is the weakest of the three of the bull, and that clearly has not been the case this year because of what happened in April and kind of the slingshot that sent us higher again. So I happen to think that 2026 is not going to be as strong as 2025. Low double-digit returns, we'll take those. That's pretty positive. And I do think that at some point we're going to have another cyclical bear market like we did in 2022, like we did in the fourth quarter of 2018. We're going to have another one. The timing of that is probably going to be pushed out several more quarters.
If you had to make a guess, what's the next healthcare? Like the thing that's been sleeping that people are not paying any attention to and is gonna have the potential to have a pretty good 2026. There's something that jumps out to you right away?
Yeah, consumer staples. You know, it's a sector that we hate to hate. We love to hate, I'm sorry, because they're expensive. Remember, the two best consumer staples names, Walmart and Costco, are really big, giant discretionary retailers, but they've become more staple-ish. There's been a lot to hate about how expensive they have been in terms of PEs and earnings growth. I say the other one has to be REITs, because REITs is an area that is obviously more rate dependent. And then my favorite contrarian play of all is, as you know, small caps. We've been waiting for small mid cap to really get going. And if the cycle really gets going in terms of lower interest rates, they're already there fundamentally, Scott. Small mid cap stocks are already there fundamentally in terms of earnings growth, cash flow, and importantly, they're paying dividends. So I think of all three of those areas that I mentioned, consumer staples on a sector basis, REITs on a sector basis, but from an asset class basis, it's got to be small mid cap.